I only want to know where I will die, so I will never go there. That was a quote from Charlie Munger, the man behind Warren Buffett, the man who helped build one of the greatest investment empires in human history. And that quote, just one sentence, changed the way I look at the entire financial market. Most people, when they step into trading, ask, how do I make money? What is the best strategy? What is the holy grail indicator? What is the next 100x trade? But Charlie Munger asked the opposite question. He did not ask how to live forever. He asked, where will I die? Then avoid that place. That's simple. And that is exactly the mindset that 99% of failed traders never have. Today I will talk about that. About why avoiding mistakes is the real superpower in trading. Not a fancy strategy, not a complex algorithm, not insider information. Just simply, do not shoot yourself in the foot. It sounds easy, but let me prove to you why most people do the opposite every single day without even realizing it. Let's begin with an uncomfortable truth. Most traders lose money not because the market is too difficult, not because they are not smart enough, not because they have not learned enough technical indicators. They lose because they constantly sabotage themselves with mistakes that are completely avoidable. Mistakes that do not require a high IQ to recognize. Mistakes that, when looking back, everyone can clearly see were wrong, but in the moment of doing them, they still do them. And that is the truly frightening part. I want you to think of the market as a long-term survival game, not a sprint, a marathon, not a one-day match, a war that lasts for many years. And in a war that long, the final winner is not the person who attacks the hardest. It is the person who does not make fatal mistakes, the person who stays alive the longest, the person still sitting at the table when everyone else is left with empty pockets. The market does not reward temporary intelligence. It rewards the person who survives long enough. So, what are those stupid mistakes? I will go through them one by one, not just to list them for the sake of listing, but so you can see the psychological mechanism hidden behind each mistake. Because if you only know the name of the mistake, but do not understand why you make it, you will keep making it in another form. I guarantee you that. The first mistake, using too much leverage. Leverage is a double-edged sword that everyone knows is dangerous, but still uses incorrectly. Why? Because leverage amplifies emotions, not just profits. When you use 20 times leverage, 50 times leverage, 100 times leverage, every small market movement becomes a tsunami inside your psychology. One candle moving against you suddenly makes your heart beat faster. Your hands begin to shake. Your decisions begin to be guided by fear, not by analysis. Many new traders look at leverage and see only one thing, a chance to make money fast. They think, if I put in $1,000 with 100x leverage, I can make money as if I am trading $100,000. Correct. But they forget that they can also lose as if they are trading $100,000. And the market only needs to move a tiny bit against them for their account to be liquidated. Done. Game over. No chance to recover. This is what no one tells you when they introduce leverage to you. High leverage does not only increase risk mathematically, it also destroys your ability to make rational decisions psychologically. You cannot think clearly when your money is evaporating second by second. The human brain was not designed to withstand that pressure. And when the brain does not function properly, you will do crazy things. Hold a losing trade too long because you refuse to admit you were wrong. Exit a winning trade too early because you are afraid of losing. Add more positions in the opposite direction because you think the market must reverse. All of those things are caused by leverage that is too high. Professional traders often use very low leverage or no leverage at all, not because they do not know leverage can amplify profits, but because they know calmness and rational thinking while trading are more important than any leverage, and low leverage allows them to keep that. The second mistake, going all in and not managing capital. All in sounds very cool in movies. When the main character puts everything into one final gamble, then wins, the audience applauds. But the reality of the financial market is completely different. All in is not courage. All in is recklessness. And recklessness in trading is not rewarded. It is punished. Capital management is the foundation of every trading system that can survive long term. Oh, not the entry strategy, not technical analysis. Capital management. A trader with an average strategy but good capital management will survive longer and make more money than a trader with an excellent strategy but poor capital management. Why? Because of mathematics. If you lose 50% of your account, you need to make back 100% just to return to break even. Not 50%, 100%. If you lose 80% of your account, you need to make back 400%. That is why large drawdowns are almost impossible to recover from in practice. Not because of a lack of skill, but because the mathematics of losses is always asymmetric in a direction that works against you. Good traders usually risk no more than 1 to 2% of their account on each trade. That sounds too little, doesn't it? But that is exactly why they are still here after many years. If they are wrong 10 times in a row, they lose around 10 to 20% of their account. Painful enough to learn a lesson, but not enough to destroy them. Meanwhile, if you risk 20% on each trade and you are wrong 5 times in a row, your account is basically dead. As for going all in, the question you need to ask is, are you really that certain? Do you have more information than the entire market? Because when you go all in, you are betting that you are right and everyone else is wrong. And history shows that absolute confidence is often a sign that you are missing information, not that you have enough information. The third mistake, FOMO, fear of missing out. This is one of the most dangerous enemies of a trader, and also one of the hardest things to fight. Because FOMO does not attack you when the market is quiet. It attacks you right when the market is exploding, when everything is bright green, when everything is burning red, when huge numbers are being posted everywhere, when everyone around you is shouting about how much money they just made. FOMO is the feeling that you are missing something important, and the human brain is programmed to hate missing out more than it likes receiving. This is a psychological bias called loss aversion, which means the pain of losing something is more than twice as strong as the pleasure of receiving something equivalent. And FOMO exploits exactly that weakness. Thus, when a coin pumps 200% in one day, when someone on Twitter posts a portfolio that has gone up 10 times, when your friends tell you they just made an amount of money equal to 6 months of your salary in only 1 week, your brain does not process that information rationally. It processes it as a threat, as if you are being left behind. And your survival instinct screams, jump in now, or it will be too late. The result is, you buy the top. You enter a trade without a plan. You do not know where you will exit. You do not know how much risk you are accepting. You only know that you cannot sit and watch anymore while other people are making money. And the market has been waiting for exactly that moment to reverse. Here is the truth about FOMO that no one wants to hear. Most FOMO trades are the worst trades you will ever place. Not because you are unlucky, but because when the whole world already knows about an opportunity, that opportunity is usually already gone. Financial markets reward the people who arrive early and punish the people who arrive late. The only way to fight FOMO is to build a trading process so disciplined that there is no room left for impulsive decisions. If the setup is not in your plan, you do not enter. No exceptions. No, just this once. No, last time. Do not enter. The market will always have another opportunity. But if you keep FOMO trading, you will no longer have capital to take advantage of that opportunity. The fourth mistake, revenge trading. This is the mistake I bet most people in this room have made at least once. You lose a trade, a painful loss. Maybe it was a large trade. Maybe it was a trade you were very confident in, and immediately some emotion erupts, anger, shame, a wounded ego, and you want to win it back immediately, right now. The next trade, double size, triple size, to prove that you were right. That is revenge trading, and that is the fastest path to losing even more money. Why? Because you are no longer trading based on analysis. You are trading based on emotion. You are trying to beat the market because you feel the market has just humiliated you. But the market does not know who you are. The market does not care that you are angry. The market has no emotions. Only you have emotions. And that emotion is destroying your ability to make decisions. Revenge trading often leads to a spiral. Lose trade 1, enter trade 2 to win it back. Lose trade 2, enter trade 3 with a larger size. Lose trade 3, and suddenly you realize you have lost more than 3 times the original loss in just a few hours. People call this tilt. The term comes from poker. When a poker player is on tilt, they no longer play according to probability and logic. They play according to emotion. And a casino, or the market, loves nothing more than a player on tilt. The solution to revenge trading is so simple that it sounds almost funny. When you lose a painful trade, close the computer. Go outside. Do something completely unrelated to trading. Let your brain reset. Let the emotion settle. Then come back. Not after 5 minutes. Not after 30 minutes. Sometimes after a whole day. Sometimes after a few days. That is not weakness. That is discipline. The fifth mistake, not cutting losses. This is the most common mistake and also the most devastating one. And it comes from a very human psychological weakness. No one wants to admit they are wrong. When a trade moves against them, most people do not think, I was wrong, I need to cut the loss. They think, the market is about to reverse. I just need to wait a little longer. I am not wrong, I am just earlier than the market. And during that time, the trade continues to lose, a little more each day, until a small loss becomes a large loss, and a large loss becomes a disaster. Why do we not cut losses? Because cutting a loss is the act of turning an unrealized loss into a realized loss. When you have not cut it yet, that loss is only a number on the screen. There is still hope. It can still recover. But when you cut it, you officially admit, I was wrong. And the human brain hates that more than almost anything else. But here is the truth. The market does not know where you entered. The market will not come back to save you because you are losing money. And every day you hold a losing trade without cutting it, you are paying a price. Capital is locked, other opportunities are missed, and psychological pressure slowly accumulates and destroys your judgment for every next trade. Professional traders set their stop loss before entering a trade, not after, before. They decide, if price goes here, I am wrong, and I exit. No need to think more in the middle of it. The decision was made beforehand, when the mind was still clear. And they respect that decision no matter what their emotions say in the moment. Cutting a loss at the right time is not losing. It is management. It is protecting capital so you can fight again tomorrow. The sixth mistake, trading based on emotion. If you ask me what destroys the most trading accounts, I would say emotion. Not a bad market, not bad luck, not a wrong strategy. Emotion. Fear and greed are the two emotions that dominate trading. Fear makes you exit a winning trade too early because your profit could disappear at any moment. Greed makes you hold a winning trade too long because you think you can still make more. Then the market reverses and the profit disappears. Fear makes you afraid to enter a trade when a perfect setup is right in front of you. Greed makes you enter a trade when there is no setup because you want to participate in the market movement. And we cannot eliminate emotions. No one can. Anyone who tells you they trade without emotion is either lying or deceiving themselves. Emotion is part of being human. The question is not how to eliminate emotion. The question is how not to let emotion make decisions for you. The most effective way to do that is to have a detailed trading plan and follow it mechanically. That plan includes what the conditions are for entering a trade, where the stop loss is, where the target is, how many % of the account you risk, and nothing else. When you have a plan and follow the plan, you do not need to make decisions while the market is moving and emotions are rising. You only need to execute the plan. This sounds simple, but in reality, it is extremely difficult. Because the market constantly creates situations where emotion tells you, this time is different, this time is an exception, this time the plan does not apply. And your job is not to believe that voice. The seventh mistake, thinking you are unbeatable after a few winning trades. This is one of the most dangerous mistakes because it does not appear after you lose. It appears after you win. And you do not feel that you are doing anything wrong. You feel that you are doing everything right. Imagine this. You have just won 5 trades in a row. Your account is growing nicely. You begin to think, I have found a way to beat the market. My strategy works. I am better than I thought. And from that thought, you begin to change your behavior. Larger size, higher risk, less patience with the plan, more willing to ignore warning signals. And then one large trade comes and wipes out many weeks of profit in just one day. Psychology calls this overconfidence bias. After a streak of success, human beings tend to overestimate their skill and underestimate risk, partly because they forget that in trading there is an element of luck. Not 100% of the result comes from skill, and after a winning streak, you cannot know what percentage was skill and what percentage was simply the market moving in your favor. Professional traders do not change their risk management after winning. They do not increase size after a winning streak because they feel confident. They understand that the market does not know how many trades you have just won. The market does not give you credit. Every trade is an independent event. And the next trade could be the worst trade in your trading history, no matter how many times you just won before that. Now stop and look back at all the mistakes we have just discussed. Too much leverage, going all in and not managing capital, FOMO, revenge trading, not cutting losses, trading based on emotion, thinking you are unbeatable. Do you notice what they all have in common? Not a single one of those mistakes requires a lack of intelligence. Not a single one requires a lack of technical knowledge. They are all problems of psychology, of self-control, of discipline. And here is the interesting thing. You do not need a complex strategy to survive in the market. You do not need to be better than 95% of other traders in technical analysis. You only need to avoid making these basic mistakes. That is all. Just by not shooting yourself in the foot repeatedly, you are already ahead of many people. There is a story I want to tell. An investor named John did not have any special strategy. He only had a simple set of rules. Never risk more than 2% of the account on one trade. Never trade without a stop loss. Do not trade when emotions are rising, and do not read news before trading. That set of rules sounds very ordinary. Nothing fancy. But while the traders around him, people with more complex strategies, were blowing up their accounts during periods of major volatility, he was still had capital, still trading. And because he was still there, he had the chance to take advantage of the good setups the market continued to create. In the long run, he was not the best trader in the room, but he was the one who survived the longest. And that is what truly matters. What does Munger's inversion thinking look like in trading in real life? Instead of sitting there drawing out the best possible scenarios if this trade wins, sit down and draw out the worst scenarios. Ask yourself, what could go wrong in this trade? If I am wrong, what is my maximum loss? What could make me lose my entire account? Then make sure that none of the answers to those questions can wipe you out of the market. This is the pre-mortem technique, a technique widely used in professional risk management. Instead of waiting until after failure to analyze why you failed, you do it before. You imagine that this trade has failed. And you ask, why? What happened? That answer often reveals risks you have not recognized yet. There is one important thing to understand about the difference between traders who survive long-term and traders who are eliminated by the market. It is not the win rate. Win rate is not the most important measure. A trader can win 60% of trades and still lose money if the losing trades are much larger than the winning trades. And a trader can win only 40% of trades and still make good money if the winning trades are much larger than the losing trades. What truly matters is the risk-reward ratio and consistency. And consistency only comes from discipline, not from intelligence, not from luck, from discipline. Discipline means doing the right process even when you do not want to, even when everything inside you is telling you to do the opposite, even when the market is driving you crazy, even when you have just lost and want to win it back immediately, even when you have just won and feel unbeatable. Discipline is what separates trading as a profession from trading as gambling. I want to talk about something few people discuss, the cost of not knowing what you do not know, the things you do not know that you do not know. When you first start trading, you do not know many things, but you also do not know that you do not know. You see the chart, you see the candles, you see the trend lines, and you think, I understand this now. I know what it is doing, and that is when you are most dangerous. Not when you know nothing, but when you do not know that you know nothing. The Dunning-Kruger effect, a well-studied psychological phenomenon, shows that people with the least knowledge are often the most confident, because they have not learned enough to understand that they do not understand. In trading, this is extremely dangerous, because confidence without a foundation will lead to reckless and unnecessary decisions. The solution is not to constantly learn new strategies. The solution is to build cognitive humility. Always remind yourself that the market knows more than you, that you can be wrong, that every trade has probability, not certain, and therefore, every trade must be managed with proper risk control. Let's talk about a concept called negative space in trading. In art, negative space is the empty space around the main subject. Sometimes negative space is more important than the main subject. In trading, negative space is the time when you do not trade, the moments when you sit and watch the market and do nothing. And this is something many traders never learn. Sometimes doing nothing is the best decision you can make. Overtrading, meaning trading too much, is a common disease. It comes from many causes: the feeling that you always need to do something, not being able to tolerate boredom, pressure from trading fees that need to be compensated by profit, or simply liking the excitement of placing trades. But none of those reasons is a reason to trade. The only reason to trade is that the setup has met the conditions in your plan. Professional traders can sometimes sit for an entire week without placing a single trade, not because they are lazy, but because the market has not given them a qualified setup, and they understand that a bad trade will cost far more than not trading at all. Patience in trading is not passivity. It is an active strategy to preserve capital and energy for real opportunities. Now, I want to talk about something that few people discuss, but is extremely important: your trading environment. You cannot control the market, but you can control the environment around you when you trade, and that environment affects your decisions more than you think. If you trade in a noisy room with constant distractions, your phone vibrating constantly, notifications from Telegram groups, and Twitter pouring in non-stop, you are sabotaging your ability to focus. You cannot make high-quality decisions in an environment like that. If you trade while tired, hungry, or after an argument, you are trading with a brain that is not in its best state. And a brain that is not in its best state will make mistakes that your normal brain would never make. Serious traders treat trading like a professional job. They have fixed hours. They prepare before sitting down to look at charts. They do not trade when they do not feel well. They turn off unnecessary notifications. They build a morning ritual to prepare their psychology. All of those things may sound unrelated to charts or strategy, but they directly affect the quality of your decisions. I want to dedicate one part to talking about learning from your own history. One of the most powerful tools in trading is a trading journal, meaning a journal of your trades. Not just recording profit and loss, but recording your mood when entering a trade, the reason you entered that trade, what you were thinking when you exited, what you felt after the trade closed. When you look back at those journal pages after a few months, you will see clear patterns. You will see that your worst trades are often entered after a specific chain of events. Maybe after you lost a large trade, maybe in the late afternoon when you were tired, maybe when you had just read some hype analysis on social media. You will see weaknesses that you did not know you had. And from there, you can build rules to protect yourself from those weaknesses, not someone else's generic rules. Your own rules based on real data from your real behavior. This is exactly Munger's way of thinking. Find out where you will die, and a trading journal is the tool to do that. There is a question I am often asked. If avoiding mistakes is the most important thing, does a specific entry strategy still matter? The answer is yes, but less than you think. Research on trading shows that the difference in profit between two entry strategies that are relatively similar is often much smaller than the difference in profit created by different capital management and different psychology. In other words, two people using the exact same entry strategy can have completely different results just because their psychology and capital management are different. That does not mean you can enter trades randomly and still make money. You still need an edge, meaning a real advantage in the market. But that edge is not some secret complex thing that only skilled people have. That edge is often simpler than you think, and it only works when executed with discipline and proper capital management. To move toward the ending, I want to talk about an interesting paradox in trading, The people who try to make money the fastest are often the people who make money the slowest, or make no money at all. Meanwhile, the people who focus on avoiding mistakes, protecting capital, and trading consistently are often the people who build real wealth over time. The financial market has a natural mechanism for eliminating people who are not suitable. Leverage that is too high, risk that is too large, lack of discipline, no capital management. Those things do not lead to immediate failure. They lead to a chain of lucky moments and disastrous moments. And eventually, the disastrous moments will wipe everything out. Mathematics guarantees that. But the people who build a sustainable system, with controlled risk, with real discipline, will stay long enough for the market to reward them. Not today, not next week, but over time. Returning to Munger's quote at the beginning, "I only want to know where I will die, so I will never go there." Applied to trading, that means know the things that will destroy your account. Then avoid those things at all costs. Too much leverage can destroy your account. Avoid it. Going all in on one trade can destroy your account. Avoid it. FOMO can destroy your account. Avoid it. Revenge trading can destroy your account. Avoid it. Not cutting losses can destroy your account. Avoid it. Trading based on emotion can destroy your account. Avoid it. Thinking you are unbeatable can destroy your account. Avoid it. You do not need to be a genius. You do not need a secret strategy. You do not need to be better than the market. You only need to not go to the places that will certainly kill you. That is the real superpower in trading. Not excellent analysis, not fast reactions, not reading the market like a god, but the ability to recognize the mistakes that can destroy you and consistently refuse to make them, day after day, month after month, year after year. The market does not reward temporary intelligence. It rewards the person who survives long enough. Survive.